of knowledge with us today. With a career span of more than a decade, Mr. Ramesh has held key roles in renowned financial institutions like Credit Suisse and Citibank, establishing himself as an expert in the field of credit risk modeling and analytics. An alumnus of IIT Madras, Mr. Ramesh's academic excellence is complemented by his practical expertise in FRM, financial risk management, and he is holding a dual degree in mechanical engineering and a certification as a FRM. He seamlessly blends technical proficiency with a keen understanding of the financial intricacies. Today, we are fortunate to have Mr. Ramesh shed light on the critical topic of risk management in today's volatile economy. Without further delay, please join me in expressing the gratitude to Mr. Ramesh. Sir, now you may take over the session.
Thank you so much, Yashika, for the warm welcome. Uh,
You're welcome,
and
sir.
thank you all for joining this early on a Sunday morning. Uh, let me just share my screen so that, let me know when you guys can see it.
Yes, sir,
Can you?
it's visible.
Okay, okay. Perfect. Very happy to be here. Very happy to meet you all. I think Yashika already explained uh, my background, right? So just reiterating, right? I've been in these global, systematically important banks like Citi, Credit Suisse, and Morgan Stanley for almost 12 years, devising analytical solutions for them. Uh, I I have an FRM. I've studied FRM, which is an exam conducted by the Global Association of Risk Professionals. And I also have my BTech and MTech from IIT Madras in engineering. Right. Personally, I enjoy traveling, board games, and playing with my 2-year-old son in my free time. And of course, risk management and analytics interest me, and I'm very happy to have spent so many years in this area. Right. So enough about me. Uh, I we can just dive right in to the subject. Uh, One request that I have uh, to all of you is let's make the session interactive. So I am as much a student of risk management as you all are. I am happy to learn more about how consumers and talent that are graduating in this decade uh, think what matters to them, uh, how they see the world, how they are going to shape the world, and how risk management will be relevant to that, right? So let's make it interactive, uh, and I'm excited to learn from all of you as well, right? With that, let's jump right in. So let me start off with something very basic, which is risk in business, right? The definition of risk is an exposure to potential danger, loss, or harm. Loss is mostly what we face in financial risk management. It's a nice desk job. Uh, but there is a lot to learn about what can cause loss and how we can quantify and manage uh, risks that cause these losses, right? Uh, so my view on risk is that any transaction that is completed over time in any practical business carries risk. So if I were to go to a shop and I understand the Indian currency, I just give the shopkeeper some money, collect some goods from her, and I return home. That wouldn't carry uh, any financial risk. Uh, However, Businesses take time to build high quality products, services, and take some more time to finally sell them. And when you put in that element of time, some uncertainty creeps in, and that can result in a risk for a business, right? So just something for you to think about, right? Do you think that a game with no entry fee that happens on the spot, right? Say it's a roll of a die, right? Like that, where you can win anywhere between 0 rupees and 1,000 rupees. Do you think such a game carries any risk?
Not any financial risk, I guess.
It doesn't, right? Yeah, but unfortunately, this is an example of a free lunch, right? You go in, you pay nothing, you either get something or you get nothing and you get out, and you don't even waste time. Businesses very rarely are built on an assumption that free lunches will sustain over an extended period of time. Hence, risk management is something that every business invests in directly or indirectly, right? Any counter views, any questions on this point, on the definition itself? Okay, if not, so moving on. So what this means is that businesses and banks are interested in managing risks, and banks often help businesses by playing a key role in managing these risks and making many modern economic activities possible, right? Uh, and empirically, history has shown that banks and businesses that manage risks well, they survive longer, right? Because they have thought about adverse events, they deliver stable earnings, and are often rewarded by the market with higher PE multiples. So, other things being equal, if there is a company A which delivers the same returns without any fluctuation in a very stable fashion over a long period of time, market rewards it with some premium, right? Okay, and we don't have to wait for a Q&A at the end. We can keep it informal. I'm happy to discuss and talk about anything on every slide as before we move on to the next slide. I just I don't know if you want to ask Yashika to raise your hand or ask Rashika or just unmute yourself. Ask.
Yes, we can have an interactive session in place of Q&A if you want.
Sure. Okay. So moving on to the next slide, let me talk about
Ashika,
some. Yeah,
साउंड तो बढ़िया है इसका ना.
Everyone, please stay on mute.
yeah. Uh, Moving on to the key risks that we face in banking, right? Uh, so there are you can classify risks into different categories. I've just put together some that key things that I look for, right, when we look at risk. So the first one is credit risk, right? So if you owe me 100 rupees in principal and 5 rupees in interest next year, right? This is a very simple one, but does anyone have a view on what could go wrong? How can I face a loss in such a situation?
So if I'm unable to repay due to unforeseen circumstances,
Right,
that
right,
it might be a loss.
right. Perfect. So that's credit risk for you, right? The customer's credit worthiness deteriorates. They are unable to make the payment at the time when they have to make a payment. and then I have to bear a loss as a bank, right? The second kind, again, which is fairly straightforward, is where you owe me 100 rupees in principal and 5 rupees in interest next year, uh, on a loan that I plan to sell off, right? So if I don't know if you're familiar with markets for securitization, for example, right, where banks originate some of these loans and then they sell it off to third parties, and then they only take some servicing fee uh, after that, just to play the role of the interface between the final owners of the loan and the retail customers. Uh, can you tell me what could go wrong in this situation? How I could face a loss in such a
Maybe I have taken a loan at a higher interest, more than 5%, and I will be bearing that loss because I'll be getting a return of 5%, and I'm taking more than 5%. I'll be paying off more than 5% as interest.
brilliant, right? So I have to think about if I am going to get only 100. I have given you 100 rupees right now, and I have bought this loan effectively from you, which I will sell off to someone else. And if interest rates go up, then the loan is not worth 100 rupees anymore, and I may only get 98 rupees when I sell it off to the buyer, right? That means I face a loss because the market moved, right? That introduces market risk. Market risk is mostly seen on the trading book, right? But I just want to keep things simple. Right? The third one is what is called non-financial risk, right? Again, suppose there is no credit or market risk. Do you think there is a non-financial risk which could cause a loss? Yeah. So non-financial risks are, for example, risks that come from human beings, employees, for example, fraud, uh, systems, right? Today, I know that you owe me 100 rupees and 5 rupees next year. What if there is a big system outage and I don't know who owes me how much anymore, right? That would be an example of operational risk or a non-financial risk, right? I can also share a couple of, at least one example recently. Uh, so Citigroup had a customer, Revlon, uh, for whom they had to transfer 7.8 million USD of interest to Revlon's customers, right? Due to some internal controls failure, they transferred the entire loan amount of 900 million to the lenders. So instead of transferring 7.8 million in interest, they ended up transferring 900 million to the customers. And then they had to fight legal battles for the next couple of years to get back some of it and then settle on the rest of it. And they also had to face a fine of $400 million from the regulators for poor internal controls, right? So this is an example where there wasn't a direct credit or a market risk, but an operational risk because of a system issue or a people issue, for example. Right? One more example that I have is around 2016, Wells Fargo got into a big scandal. So what happened is, like banks globally, their sales representatives had quarterly targets, and to meet those targets, they would open fictional accounts. Uh, they opened fictional accounts for their customers, and they did some transactions on behalf of customers, which was obviously illegal, right? If now it's been 8 years and people estimate that the impact of that fraudulent practice which Wells Fargo faced could be around $5 to $8 billion if you include the fines that regulators imposed on them, the outflow of money because there was a reputational damage, So non-financial risks, if not monitored and controlled properly, can result in big losses like this, right? Any questions? Any other views? Hmm. If not, let's talk about liquidity risk, right? Now you owe me 100 rupees in principal and 75 rupees in interest 10 years from now. Does anyone want to, take a shot at what could go wrong in this?
So, is it concerned with time value of money?
Uh, Not necessarily time value, because time value of money would be covered in market risk. So your position becomes less valuable, and then you face a loss there. But a situation where you have a very long-term loan on your book, or you have only very long-term loans on your book, can result in a can result in a problem, because your depositors who actually have a lot of savings and current accounts with you can come and ask for money at any point of time, right? Now, if I only get money 10 years from now, but my depositors suddenly 1 year from now decide that, I want to withdraw a lot of money from this bank, then my liquidity position is not great, right? So asset liability management is a major treasury function in banks that looks to avoid situations like. So one recent example that I can give you, where a bank collapsed because they faced this risk, is that of the Silicon Valley Bank. I don't know if you have heard of it. In 2022, this was this was in the news, because what had happened was this bank had a lot of savings accounts, money coming from savings accounts from well-to-do customers in Silicon Valley, but they had invested all of this money in long-term bonds where the payoffs would come after a long time. As the interest rates went up, customers realized that the bank is not actually making a lot of money. So when you buy treasuries over a very long time today and the interest rates go up, suddenly the value of uh, these treasury bonds that you hold will go down, right? And please feel free to stop and ask me any questions if some of it is not making sense to you, right? So what this did is that this reduced the profitability of the bank. The net interest margin of the bank went down. A lot of these customers had so much money in the bank that it was not insured by the government. So, for example, in India, we have, I think, a 1 lakh cap for money that is insured when you deposit in a bank. Uh, so the customers quickly came to the bank and pulled off their money, right? So this resulted in a liquidity situation for the bank. When they tried to sell these long-term bonds on their books, they had to sell it. They found it difficult to sell them. They had to take big haircuts, and that resulted in finally the bank collapsing, and then it was bought by First Citizens Bank, right? So this would highlight the importance of asset liability management and interest rate risk management for banks, right? Uh, and one other kind of risk that I want to talk about that is all encompassing is reputational risk, right? Uh, I don't know how many of you have heard of the idiom, you can take that to the bank, right? The idiom means whatever they're saying is so reliable and trustworthy that it is comparable to the reliability and trustworthiness of a bank, right? And the moment you can't use that idiom for a bank itself, you know that the bank is in trouble, right? So reputational risks, especially for these big banks, are very important. They span across these other risks. And the moment the world loses faith in a bank, the other risks are just a row of dominoes waiting to follow, right? So one example of reputational risk that I can give you is that of Credit Suisse, right? So in 2019, there was a scandal where one of the senior MDs of Credit Suisse had left for UBS, and there was some spying on this individual from someone in Credit Suisse, right? Eventually, the CEO got fired, but that only led to a series of events, including big credit losses that came from hedge funds in 2021. And then after that, clients just started pulling off money in 2022 and 2023. Regulators had to step in and finally sell off the bank to UBS, right? There was also a scandal about the CEO not following COVID guidelines. So there were a lot of these scandals which started hurting the reputation slowly. Couple of big credit events, and money started flowing out of the bank. Reputational risk is one major risk that is probably unique to maybe banks and healthcare companies, right? Uh, any questions on the key risks you feel you feel there's some other kind of risk also that we should discuss, or any questions on the ones we have discussed?
So doesn't reputational risk come under non-financial risk?
Uh, you could call it that, but I just mentioned it separately because everything can cause reputational risk. So if there is a couple of there are a couple of big credit events, even though that's a credit risk, it can eventually result in reputational risk without any scandals or anything, or without any operational events or fraud, right? So you're right in a way, it's a non-financial risk because there's no financial element directly to it. But I just want to leave the fact that reputational risk is very, very important for a bank. That's why I put it.
Okay.
But that's a good point. I agree.
Sir, what steps can banks take to protect and enhance their reputation in the market?
Uh, Actually, banks do their best to build a reputation already, right? So branding is an example, right? Performance over time, because nothing builds reputation more than thriving in a market for a very long time. Uh, but apart from doing a very good job over a long period of time, I would say branding is one key element that would go in building a good reputation. Okay, moving on to the next slide, right? So we understood what can cause these uh, these losses, right? That we don't want. Uh, but then the fact is there can be a whole bunch of losses that can occur at different points in time, right? So we don't want to. So if you look at the curve on this slide, right, we call it the loss distribution curve. So whenever for any bank in business, you would expect some loss. So the probability or a frequency of zero loss is very little. Your losses will generally lie in some range, right? Say 3 to 10% of your assets. Just putting a number out, right? So that is where mostly your losses will be. That is the kind of loss you will see generally. But then there will be a few cases, a few bad years, recessions, downturns, right? When the losses will be really huge, right? So this distribution will generally have a very long tail. depending on how good the risk management practices are, right? So this is what your loss curve will generally look. And there are some key points on this curve that risk managers are interested in, because you can't really manage risk for every point out there, right? So my first question to you is, why do you think banks are interested in calculating expected losses of their portfolio?
It
So,
may
so that
it may be to calculate how much risk they can take. Like evaluate their risk appetite and consider how much loans they can give and how much risk the current portfolio holds and what they can expect.
Right.
So
So
that
banks want to know how much loss they can expect. That is one important point, and they want to plan accordingly, right? So if you look at a bank's income statement, for example, you'll see a provision for credit losses, which is really the expected loss for which banks provision, right? But there's one more important reason why banks want to look at expected losses. Anyone else wants to try?
Maybe to know how much liquid assets they should hold.
Right, right. So this for risk management, definitely risk management and planning, it is important, right? But would you price a 10 lakh rupee home loan and a 10 lakh rupee personal loan the same? And if not, why?
obviously there will
No,
be
sir.
different.
You won't, right?
No, sir.
Why?
They won't be.
Yeah,
Can
go
I
ahead.
answer? Sir, they can't be priced at the same level since the magnitude of risk uh, uh, is much more in the case of a personal loan, as 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 there is no underlying asset or commodity which which can be you know held by the bank till uh, till till the entire loan amount is paid back. Uh, uh, Contrastingly, in the second case, the bank can always seize the house, seize the ownership of that house uh, uh, till the entire loan is
Brilliant,
so
right?
so the magnitude of executed risk is very.
Right. That, yeah, that's right. So, even if the customer is the same, the 10 lakh loan amount is the same, you would price a home loan differently from a personal loan, because you have some collateral for a home loan, which will drive down the expected loss in the event of default, right? So expected loss also plays a role in pricing of different products, right? So yeah, I mean that was a brilliant answer, right? So having some collateral reduces your expected loss, and therefore the spread that you need to charge over your borrowing rate goes down, which is why expected losses are important for a bank, both for risk management and planning, and also for pricing different products, right? Uh, the second kind of loss that banks are interested in is unexpected loss, right? Uh, so unexpected losses are important because banks can calculate and plan for all sort of expected events, come up with an expected loss number, but in no year will your actual loss amount be exactly equal to the expected loss amount. There are going to be years when your actual loss amount is lesser than what you expect, and there are years when it's going to be more than what you expect. And there are years when the loss amount is going to be much higher than what you expect. What that means is lawmakers, right, are interested in ensuring that these banks survive even in very bad years. That is, if there is a very bad year, the bank should not end up using the depositors' money to pay off the bad loans. It should always have the buffer of owner's capital to be able to pay off those bad loans, right? Uh, Banks are are much more leveraged than your traditional industries. So this is something that regulators and lawmakers and society in general really cares about. That the risk taking that a bank participates in should not affect the common man who's just deposited money in a bank, right? So if you're running a very volatile business with a very low expected loss, your capital requirements, the money that the shareholders have to put in such a bank will be quite high. The regulators will mandate that, right? Now, with that context, can you tell me which financial ratio can these high unexpected losses adversely affect?
The capital adequacy ratio.
Right. So capital adequacy has something to do with it, right? So if you have a lot of unexpected losses, your minimum capital requirement will also be very high, which means for making the same amount of revenue, the owners will have to put in a lot of capital, right? So that means that your return on equity or your return on capital is going to be lower if your unexpected losses are higher because the bank is run in a very risky fashion. Does that make sense? Any questions on that?
Sir, sir, but sir, but uh, 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 in the event of a default, uh, there won't be any return on the invested amount or the capital that has been extended, right?
Uh,
Oh,
right, right. So I'm not talking about a case where the bank has already defaulted. I'm talking about the case where the bank has low expected losses but very high unexpected losses. So if you have very high unexpected losses, RBI will ensure that your owner's capital is very high, right? So even when you don't have a very bad year, your capital requirements will be so high, the equity amount coming from the shareholders will be so high that your return on equity will be your earnings divided by this very high uh, capital amount that the owners have put in, right? So I'm not talking about the bank itself collapsing. I'm talking about the case where a lot of the bank's customers collapse. The bank may still be solvent, right? But you raise an important point. So if the unexpected losses are very high and the bank is seen as a very risky entity, people will anyway try to avoid it, right? Irrespective of how much return they're getting on equity, right? That's one other way of looking at it. Any other thoughts?
sir, I
Hmm.
have a question. Um,
Yeah.
um, so, sir, which of these two uh, is far more critical? I mean, expected loss or unexpected loss? I guess we can always plan and mitigate expected losses by actually, forecasting them. But 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 unexpected losses are, I mean, can't really be anticipated. So they bear more damage compared to expected loss, right?
Uh, I would say both are important, and there is a lot of scrutiny on both these numbers, right? The way these numbers are calculated. Unexpected losses are extremely important for the regulators because they don't want the whole system to collapse because some bank made big bad bets, right? Uh, so banks do invest a lot in ensuring that their expected losses and unexpected losses are uh, adequately calculated and managed. But I wouldn't say that one is more important than the other specifically. Both are important. Okay, moving on to the risk management process, right? So we spoke about some examples of things that could go wrong, uh, but that's a very small subset of what can happen, right? There are a lot of senior, seasoned people who worked through the Gulf War and dot-com bubble and great financial crisis, who head risk committees at a lot of these big banks, who are constantly thinking about risks that are relevant for the future, right? So the first key step in the risk management process is identification of risks that are relevant for your organization, right? Uh, and once you have identified those, you want to quantify the impact that these risks could have on your business. So this will help you prioritize and also decide uh, how deep you want to go into solving that particular risk problem, right? So if there is a risk that can just wipe out your business, you better take it seriously, put it as high priority, and build a solution for it, right? But if it's something very minor, quantity is not much, you can probably put it at a lower point in your priority, right? The third step would be to mitigate some of the risks. So banks, for example, hedge, diversify, get insurance, get CDSs, even change their business strategy where required to mitigate uh, some of these risks, right? But even after mitigating these risks, uh, there is some risk that a bank has to accept because if you completely eliminate risk, you often completely eliminate returns as well, right? So you would accept some of the risk that you're comfortable taking on your book, and finally you monitor the entire thing, right? So if you can start off identifying, quantifying, mitigating, accepting, and you can assume that the problem is solved, but then you also need to check if in the real world the risk is actually playing out the way you thought it would play, right? So the monitoring would then serve as a feedback for your risk management process. Any questions, any views on this?
So can you provide example of both internal and external factor that contribute to risk identification?
Internal, so for example, climate risk is one that is recent, right? So it is something that has been identified. Uh, we are looking at, and regulators are also closely monitoring how banks are looking at climate risk, right? So you identify which parts of your business are more likely to get impacted by climate risk, rising sea levels, increasing, wildfires, hurricanes, floods, right? Uh, you quantify the impacts, you come up with a strategy to mitigate. Some of it you accept, maybe provision a little extra for some of these risks, and then you monitor. So if over time we see that no, there is no real impact on the business because of climate change, maybe you need to re-strategize, right? Does that give you some color?
Yes, sir.
Okay. Now moving on to today's unpredictable world, right? So the team reached out to me and asked me to speak about risk management in today's volatile times, right? So I sort of modified it myself. I will be talking about not just volatile, but the VUCA world, right? Where V stands for volatility, U is uncertainty, C is complexity, and A is ambiguity, right? So technology and globalization have made big, rapid changes possible in the business world today, right? That brings about a lot of volatility in how business happens. There are big winners, there are big losers, there are very good days and there are very bad days, and these things can happen very quickly. Stability is not something that, is a feature of the world that we are living in today. The second uh, characteristic of today's unpredictable world is uncertainty, right? It is very difficult to predict with some confidence about what will happen in the future, right? The last 4 years are the best example of this. Regulatory changes, climate risk, geopolitical events, pandemic. I don't know what is going to happen in the Russia-Ukraine war. I don't know what is going to happen uh, to oil supplies from the Middle East. I don't know, right? That makes risk management very difficult and the world very unpredictable. The third bit is complexity. Even in a world where we know how to manage, we can actually tell what is going to happen, or when you can make sense of the volatility, you would still need to know how some world event in some other corner of the world is going to impact your business, right? The world is more interconnected than ever. Supply chains begin and end all over the world. You need to know what is going to impact your battery supplies, what is going to impact your medicine supplies. It need not be something that is happening in your neighborhood, right? So the world is complex, and we need to be able to make sense of what is uh, of this complexity. The last point is ambiguity. So complexity, uncertainty, and volatility are more forward looking. Ambiguity is the situation that we are in because we have a lot of data, right? We have a lot of information. We have so much knowledge that we get from social media and the web, but so much of it is propaganda. Do we actually know what is happening on the ground in Ukraine? I, anybody's guess, right? Uh, One side says X is happening, the other side says Y is happening. We don't know if the war is going to come to an end. We don't know if gas supplies are, uh, going to be as smooth as they used to be pre-war. So that is where ambiguity comes in, right? It's almost like a paradox. We have so much data, but do we actually have the the knowledge we need to make good decisions? So that is today's unpredictable world. Does anyone have any questions, any thoughts?
So, like, what risk management strategies did banks take up in the time of COVID? Like, what
Sure,
did they do?
sure. I will cover tackling or some of these things on the next slide, right?
Oh, okay.
Uh, and I'll also talk about COVID specific, right? So Maybe let's
Question.
start with yeah.
So regarding banks have like banks are required to mitigate risks and evaluate risks, but from the point of view of customers, the point of view of investors, how does a customer evaluate whether the bank has taken has taken educated risk, or maybe I should like deposit my money in that bank account or not? If a bank feels like PNB, like if my deposit is locked, how do I as a customer like get to know about the bank?
Sure. So banks have more stringent capital requirements, which is very closely regulated by the local regulator, right? RBI for us, Federal Reserve for US, FINMA for Switzerland, and others like that. So if you notice recently, RBI took some punitive action against Paytm Bank, right? So RBI, which is a regulator which comes under the government, is actually doing some of our work for us, right? So if RBI allows a bank to function, R, it already makes the bank a little safe. Uh, but I would still say you can look at some of the key uh, reserves, CET1 ratios of banks that they mandatorily have to discuss have to disclose every quarter to give you an idea of how well capitalized they are, right? Owner's capital is the buffer between our money and the shareholders, between our money and the losses that the banks faces where the banks face. So I would encourage you to look at going through their annual reports to learn more about uh, whether the bank is sufficiently capitalized. Now, it is actually impractical for everyone to go through the annual report of every bank and see if they have, they are managing their risks properly, which is why RBI sort of makes our life a little easier for us by actually doing that job. Does
Okay,
that
sir.
help?
Yes, sir, that answers the question. Thank you.
Okay, great. Uh, Actually, I thought regarding the question about COVID, right? Uh, does anyone
Yes,
have
sir.
any ideas on what we should should do for future pandemics, or even for COVID? What do you think banks should have done?
Sir, regarding COVID, recently I've come across a news article, sir. The commercial real estate bubble is about to burst in USA because many expected that after once COVID is completed, many people will be returning back to the offices. So it did not happen, and constructions went on, and the bubble is developing. So such kind of sectors must be identified. Such risk must be mitigated at first. This is what I think.
Right. That's a brilliant point, right? And yeah, I'm mighty impressed that you are actually familiar with that. So commercial real estate in office space is one big challenge that I think that at least the developed world is facing right now. And it is not just because of constructions. Actually, it is also because of the way uh, offices have changed, right? The hybrid system reduces the requirement of these office spaces. So the commercial real estate stress is actually in these office buildings, which have much higher vacancies than before, and therefore are not very lucrative to refinance, right? Or are unable to even make the payments that they were once able to make. But that's a very good point. So again, that brings about the uncertainty part, right? COVID has come and gone, but it has changed the world forever. What are we going to do? What is the new world going to look like? I don't know. Right? For COVID itself, actually, during COVID itself, and like we do for every crisis, uh, actually the focus of the bank of most of the banks was on closely monitoring every evolving situation, right? Because the government helps during all these crises by dropping the interest rates very heavily, right? Which ensures that money is cheap. Businesses can at least go through these difficult times. There were also for in India, for example, there was a moratorium period. Globally, in some of the developed economies, money was spent out, for which of course they are bearing the brunt now because of the increased inflation. Uh, but for individual banks, the focus was on closely monitoring every evolving situation and making changes to your strategy from time to time, making lending standards more or less stringent somewhere else, generally more, as and when uh, required, right? But it was luckily for us, it was a very short crisis. So in a couple of quarters, things started looking up, and then there were some pockets, a couple of quarters in 2021 in India, sometime in 2022 in China, uh, that that some of the stresses were again felt. So I would say in some ways we were lucky, but the COVID crisis, like uh, the smart chap pointed out, right, about CRE, the crisis is not yet over. Inflation is still not that great. Uh, we still don't understand the new world completely, and we will have to see how things evolve in the future.
Sir, during COVID, digital banking came into play, and it is still there now. So,
Hmm.
so that also led to very sophisticated cyber crimes as well. So, how did banks or your bank protected against that?
So, cyber crime is actually it was around even before, but really for fraud, uh, like for any other risk, right? Uh, you need to understand how frauds have happened in the past, come up with customer awareness and employee awareness programs. So, for example, we get simulated phishing emails, right? So that at least employees don't make mistakes when it comes to some cybercrime, right? There are targeted campaigns that go out to customers, say who have a certain profile that we feel may not be very uh, tech savvy, right? Uh, so it is more about creating awareness. The challenge with fraud is it is it is very difficult to keep pace with all the new ways of you know frauds occurring. So it's possible to say that this is how frauds have occurred in the last 1 year. Let's prepare for this, and then there is something new that's more cutting edge that can result in a fraud. So fraud is, I think, an exciting area. I honestly don't have all the answers, but yeah, I think it will evolve in the next few years.
Okay, so thank you.
Sir, I have a question specifically regarding to the banking industry. Many central banks in various countries are about to release their digital version of currencies. Like India has also released digital rupee. So, wouldn't this adversely impact banking industry because of reduced deposits? People would not deposit their money, or corporates would not deposit their money. Instead, they'll be depositing with the digital wallet of the central banks. So, how to mitigate this risk?
Honestly, we have not thought as much about it. It's so RBI. I know there were plans about RBI coming up with digital currency that, but has it already been rolled out? Are people using it already?
No, sir. In India, it's like in initial stages. Few payments are
Hmm,
being
hmm,
done
hmm.
in digital rupee.
Yeah,
But in the context of
the
global
digital.
scenario, many countries are about. Yeah.
Yeah, there is some talk around it. Uh, I know in the media, but it is not something that at least uh, that I've heard of much in the banking world yet. So I don't know what the time frame is on this digital currency. And generally, regulators work with big banks uh, to ensure that there's no, systemic risk suddenly because of,
Yes.
a disruption that they bring.
So, but the digital
Mhm.
currency introduced so as to reduce the transactions that were happening in cash. So maybe that if the effect won't be much for the banking industry in general. They would in they would in turn benefit from the conversion from the rolling out of digital rupee. So the purpose was
Yes.
that instead of moving in cash, doing cash transactions, offline mode of payment can be introduced by mobile phones. So that way, maybe the banking industry won't be hampered.
Yeah,
Moreover,
let's.
more, moreover, RBI gave the mandate to if you select banks to issue such currencies for its pilot project. So even if uh, 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 that digital coin currency gains traction, banks would be an inevitable part uh, of that entire new, ecosystem. So I don't think bank would go, I would say, obsolete or something.
Interesting. Yeah, we'll find out, right? There is talk about it, but honestly, it hasn't uh, reached senior bankers yet. And generally, uh, I mean, it's not the regulator's business to borrow money from people and then lend it out, right? I don't think that's the RBI's mandate. So I don't expect cannibalization. I mean, them to take away our business or something like that. Uh, but yeah, the volatility is and uncertainty is absolutely there. Uh, we'll see how this one goes as well. It's an interesting point. I'll also learn more about this. Any other? Okay. Now let's. There are some points I've jotted down about tackling some of the unpredictability in today's world. Right. Some of the things that banks are already doing, and happy to hear your thoughts and ideas also on what more banks can do in the VUCA world. Right? So for volatility, there is one way of tackling the volatility in today's world is ensuring a dynamic, agile portfolio analysis and optimization. Right. So if you have a lot of money only in edtech or fintech, that could be a problem. But if you spread it out across edtech, fintech, delivery, and others, you're probably going to be fine. Right. So to some extent, dynamic and agile portfolio uh, optimization can mitigate this feature of today's world. For uncertainty, banks perform a lot of stress tests, right? So we look at scenarios where there's a very severe recession, for example. Uh, there is a major climate scenario, major climate related event because of which we need to ensure in these stress tests that we have the capital plan ready for a very severe scenario, and the bank will still thrive in such a scenario. That is, we will have the minimum capital required even if there is a very severe stress in the market, right? Now for every stress test we need a scenario which will take care of some of these uncertainties. So we cannot say that all possible scenarios have been considered. We cannot say that all uh, possible scenarios have been considered, but we work towards it. right? We try to consider as many scenarios as possible. The other way of mitigating uncertainty is through early warning systems. So some of the latest technological advancements, for example, in AI and natural language processing, can give you a sense of market sentiment soon before the impact is felt on the indexes or in loss numbers, right? Data on the web, for example. So you can build and use early warning systems to combat some of this uncertainty before uh, the impact is felt. For complexity, I think it is important that you collaborate and partner with key stakeholders, right? Your vendors, your customers, to build awareness within the firm about every supply chain event, every event that can that can affect your supply chain, right? And for ambiguity, I would say that fostering a data-driven risk culture, right, where people feel free to communicate openly, ask questions, put in a counter view, brainstorm, that can mitigate some of the ambiguity in today's world, right? So these are some things that I have seen and thought of, and I'm happy to hear your views. Okay. So yeah, actually,
Sir, as there are ALM systems,
which systems?
sorry, go on. ALM systems, asset liability management
Right.
systems.
Okay, ALM. Okay.
Yeah, so RBI introduced these guidelines, I think, back in 2000 or 1999. So how do they play a role in risk management for banks?
Right. So is asset liability management, like I explained on slide 4, right? It's an important part of ensuring that the bank takes care of liquidity risk and interest rate risk in the banking book. That is, the treasury rates, RBI's rates move up or down, you should be able to uh, still manage without a very significant impact on your net interest income. Similarly, for liquidity, you need to ensure that your current assets and your current liabilities are not too far apart. That if suddenly there is some shock and people come and ask for their money back, uh, the bank should not go bust, right? So every regulator has their uh, prescription for asset liability management. I would say that the parent of all these supervisory guidelines is actually the Basel Committee for Banking Supervision. So I encourage you to go through BCBS documents, the guidelines and methodologies uh, that they talk about for all sorts of risk management, right? From credit to market to ALM to non-financial risk. Uh, so BCBS is a bunch of senior bankers who I probably got together in Basel first, and that's why it's called Basel Committee for Banking Supervision. And they come up with guidelines for regulators and financial supervisors globally to uh, come up with systems like these to ensure that the financial system is safe. Does that help?
Yes, for sure. I'll look into it.
So I do have a question. Like recently interim budget came in. How these regulatory changes they impact the risk management practices of the banks?
So unless there is something major uh, in the local budgets, I would say that the that RBI's requirements or the local regulators' requirements probably impact risk management more than budget itself. Budget can probably create business opportunities. Probably the business keeps a closer eye to that and probably tweaks their strategies accordingly. But from a risk management perspective, unless there is a major downside for 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 some portfolio, right? So, for example, the stamp duty registration for houses is suddenly made 20%. That could, yeah, that could probably impact the lending business and risk. But otherwise, I would say that budget is not something that directly impacts as risk management.
Thank you, sir.
So with the introduction of AI in banking industry, like for lending business, AI is being involved. So for limit of loan, the AI is improving those loans. So do you think this is a good initiative from the part of banks, or will it lead to more risk being taken by banks, which will cumulatively hamper their risk taking capacity and their financial performance?
I think every new technology should be uh, embraced, right? So, for example, this slide has come directly from Google Gemini, uh, and I think it what will happen is you utilize the latest advancements in the field and you keep a close eye on it. So if you directly use AI models, you have a team that reviews these AI models very closely, right? So if I have to create this slide directly from Gemini, I don't just take the slide and put it in here. I do my due diligence, right? I read other things also about this to ensure that uh, that the AI system has not messed up anywhere. So while banks have started using artificial intelligence, there is there are teams working closely with people using these advanced models to assess the model risk, right? What happens if there is an issue in the artificial intelligence system itself, right? So I think that's a fair, calibrated approach. Uh, right. One thing that comes to mind is that when seatbelts were first introduced, uh, the number of accidents initially went up because people started driving more rashly. So that tuning can happen over time, but I think in the long run, AI and any technological advancement is going to be good for the economy and banks.
Okay, sir.
Okay, so we if there are no other questions, I think we can close the call 4 minutes early.
Um, Sir, I think many of us are interested in the FRM exam, and since you have already cleared it, can you share us your experience about that exam? It would really help us.
Uh, sure. Even though it was a while back, I would say that I spent about a couple of months for each exam, studying for each exam, and it opened the doors for the second line of defense kind of roles for me. So I had started off working on risk management for some specific products. With that exam, I was able to think about risk for entire portfolios, right? So I think it's a useful course. It's worth devoting a couple of months for each half. I think that kind of effort should be something.
And how did you choose between CFA or FRM? Because people are also very confused about that.
I was already in risk analytics, so FRM seemed more relevant to me. But I think uh, over time you can do both of them. So I have a friend, for example, from JBIMS in Mumbai who's completed both CFA and FRM. He works in risk, but he just loves to learn as much as possible. I wouldn't say that there is a hurry or, there are a lot of roles where, freshers will be asked, why did you not complete CFA or FRM, even though it can be a bit of an advantage. So I would say without pressure, if you can complete all of it, why not?
Okay. Sir, am I audible?
Yeah.
So I think there are no more questions. So, sir,
Perfect.
on behalf of IIM Kashipur, I would like to extend our deepest gratitude for taking out time in your busy schedule and giving us an interactive session. So your session was really engaging and insightful. And the way you explained the practical examples of, say, the Valley Bank collapse or the Credit Suisse, it really provided us a practical reality of the risk management. And also, the way you talked about assessing today's volatile market using the VUCA model, that is volatility, ambiguity, uncertainty, and complexity, that was something really insightful, which we did not know it before. So it was really an engaging session, and I'm pretty sure that the session would have served as an invaluable resource to all our students. So once again, thank you, sir. And we look forward to having you again on our campus once again. Thank you, sir. Thank you so much.
Thank you so much, everyone. Had a great time as well. Bye.
Thank you, sir, for joining with us today. Thank you so much.
Thank you, sir.
Thank you, sir.